I'm with Carey Lai today, who is the co-founder and the managing director of Conductive Ventures. We are an early-stage venture capital firm with 450 million in assets under management. And today we're going to talk about his path into venture capital and starting his own firm. Great. So let's just start at the beginning. When we think about venture capital today, people think of it as a very glamorous industry. A lot of people join from product management or from investment banking and finance, many different career paths. But when you started, you're one of the few that really started right at the beginning, almost your first or second job out of college in the early 2000s. What was it like starting in venture capital back then?
So I got my first venture capital job in June of 2004. I started at IVP on Sandhill Road, and IVP is one of the storied funds that dates back to 1972. And I think for me, I had worked at a number of operating gigs during college in marketing and business development, in accounting and finance. And it really gave me a perspective on not only what I liked, but what I didn't like. And I actually found that to be really informative in terms of trying to figure out what I wanted to do in my career. And so I think I was really fortunate in that when you get to intern multiple times during the summers in college, it's a very low risk opportunity cost because it's basically 8 to 10 week internship. And I think the value of the internship is not so much what you did during those 8 to 10 weeks, but actually what you observed and what you saw, and if you could potentially see yourself in that role. And it's interesting because I think you get a sense for, do you like working at a big company or a small company? Do you like working in teams or being an individual contributor? Is this an environment that's fast paced or slow? So I think you get to start learning what is a better fit for you. And then you can start whittling away what is a ideal fit for you for your first gig. So I think for me, that was really helpful to do these internships and really observe and see if these were jobs that I wanted to do. And so by the time I had my first job out of college, my first job was in technology investment banking at Bank of America Securities up in San Francisco. And I really enjoyed it, actually. It was really challenging. It was 80 to 100 hours a week of work, but it was like drinking from a fire hose. And I think just the number of reps that you get in terms of understanding financial statements, building financial models, really learning how to evaluate companies laid a really strong foundation. So that was from 2002 to 2004. And then from 2004 on, I've really done nothing except venture capital. So I'm pretty much useless to do any job at this point.
Yeah. So back then, what was it like being a venture capital investor?
So I would say that, one, there was less capital around. There were definitely fewer funds. And to roll back the tape to 2002, in many respects, it feels like the way it does right now in 2024, 20 years later, in the sense of where the market was at. So
Interesting.
You came back from the peak of the market, which was in 2000, and I literally started in 2004, and 2002 was the dot-com bust. So 2002, 2004, those 2 years were pretty rough. It was not great being a banker at the time, and even rougher, I think, if you were in venture capital. So I think there's a nice corollary between 2000 to 2004 and then 2020 to 2024, interesting enough, through the pandemic and then the craziness of 2021 and then what we've experienced over the last 18 to 24 months. So the time frame is eerily similar, but I think what's different about venture is that the venture market was much smaller in terms of capital deployment. There were much fewer funds and even less first-time funds. It was really established funds, and each of these firms are much, much smaller. And so I think one of the biggest differences is there were definitely fewer junior venture capital professionals at most of these funds. Usually, I know this sounds odd, but usually there'd be only 1 to 2 junior professionals, and the rest were all managing directors. And that's how most firms were structured.
So what was your job scope like as a junior venture capital investor? And I think when you told me before when you started IVP, there were just a handful of people on your team.
Yeah, handful being me.
Right.
So when I first started IVP, it was just myself
Right.
and 5 partners, and that was it.
Wow.
That was the entire IVP team.
Yeah.
It was a lot of work. I was supporting 5 partners.
Right.
It was my first gig on Sand Hill Road, and I absolutely loved it. And it felt, again, I was drinking from a fire hose in a different way, but I absolutely loved it. And I think what I found really interesting about venture capital was the ability to learn about software, hardware, tech-enabled services, internet companies, consumer, business to business. So if you love learning and learning quickly because you're evaluating live deals, then it's an amazing job because you're constantly learning about new markets, new sectors. And on top of it, these things are evolving and changing really quickly.
And so you were at IVP and then you moved to Intel Capital.
Yep.
You spent, it looks like 13, 14 years at both of these big companies. What sparked something in you then to want to go out on your own and leave maybe the comforts of the stability of a larger firm? Maybe you don't have to care about fundraising. You can just focus on investing. Was there a spark or was there a certain moment that made you want to do this on your own?
So when I first joined IVP, I felt like a kid in a candy store. I felt like I was home. And I just absolutely loved the majority of the aspects of venture capital. I loved working with entrepreneurs, first and foremost. That to me was the most rewarding and exciting thing to do. I enjoyed the sometimes transactional nature of getting the deal done. And then I loved working with the companies, honestly, helping them scale, hire folks. All that was really interesting work to me. I always say my venture career can be described in 3 parts. So the first part is starting at IVP and really learning venture capital. I felt like the kid in the backseat of a car. And then when I transitioned to Intel Capital, I felt being in the front passenger seat. So I was helping to navigate with the driver. I could put things together. I was taking board seats, leading deals. And then really when I left Intel Capital, I think what changed for me was, and gave me the confidence, was I realized that I could actually generate strong returns on my own. And I said, hey, I think now it's time to be in the driver's seat. So to really do venture capital, there's not just the investing part of the business, but there's the other aspect of actually running a firm, being differentiated, thinking about what makes your firm so unique from other firms. And so it just felt like the right time to take that next step, take that leap, if you will. And if you have a unique perspective on why things should be different, then you should go and do that. And so I did that. I left with a colleague of mine at Intel Capital. We tried to raise a $100 million fund. And for a year and a half, we absolutely failed. I think we ended up...
tell us about that story. That was a fascinating story.
We ended up raising $11 million. I had 150 LP meetings everywhere from Asia to the Midwest to cities I'd never visited before. And we were just really unsuccessful at the end of the day in terms of raising $100 million. And so we disbanded. And at that point, I was really burned out. And I realized that I really didn't want to get into venture in the very beginning to fundraise. I really wanted to be in venture capital because I really loved making investments and working with entrepreneurs. The thing of it is, if you don't have a fund, the entrepreneurs aren't really going to work with you. So there is that chicken and the egg problem. But after a really big...
They want your money.
Yeah, exactly. And so after a year and a half, I decided that I would go back and just find a quote unquote regular general partner gig at some fund. And lo and behold, I came across and was introduced to Capital Source in Japan, which is what basically led to Conductive Ventures. But it was interesting because at that point I was just really about to just give up because I was just sick and tired of fundraising. Fundraising is very difficult for first-time funds, extremely challenging, and just something I didn't want to do anymore.
And I think it's interesting when you talk about that because oftentimes as venture capitalists or as investors, you may not be able to relate to actually the struggles of the founder. They see you as a capital source. But in your case, you are an entrepreneur. You are a founder yourself, having founded Conductive Ventures. Do you feel like this either gives you a differentiation amongst other VC firms, or how does it help you when you talk to founders who are coming to Conductive Ventures to fundraise now?
In a sense, I almost feel bad for all the entrepreneurs that I backed prior to being an entrepreneur.
Yeah.
Because I feel like my empathy was only so deep.
Yeah.
It's really when you start something from scratch, literally from a blank sheet of paper, that you then realize what it truly means to be a founder.
Yeah.
Everything from building IKEA furniture in our first office to trying to find capital sources, and also really the idea, in some respects, even when we were successful in getting our first fund off the ground in 2017 as Conductive Ventures, those first couple of years were still touch and go. It was primarily just Paul and I.
Yeah.
We were out there in many respects as an experimental fund because we didn't know if this was going to work. We had a thesis, we had an approach, but we were doing something that we feel even today is still very, very different from most funds on Sand Hill Road. And I think it being unproven, there's still a lot of LPs that just aren't willing to take that risk, as most of them are pretty risk averse. So I think for us, we really relate more to our founders. And I think if you interview any of our founders, the first thing they'll probably say is it's really different when we work with Carey, Paul, and the rest of the team, because we really understand what it's like to be a founder. We are going through that journey, and we have been there when things have just not worked out and things just seem so dark and challenging. And so I feel like in that sense, we're able to relate to our founders a lot more. And I think that's been the biggest transitional shift for not only myself, but I think for our entire team, is there's just something about being a founder that's so different from just being something that you inherit, whether it's a firm or an operating company. It just is very different when you're there from day zero. And I feel like we're able to really relate and help founders through some of these more challenging times.
And I think the other thing that you said that has resonated and probably resonates with a lot of founders too is your idea of this is the long game, right? You're not here for instant gratification and getting returns overnight. It's probably a different industry, not venture capital. Yeah. What kind of gave you that, I guess, the patience that you want to play the long game, so to speak, in venture capital?
So when Paul and I were at our respective funds on Sand Hill Road, so I was at IVP, as I mentioned before, Paul's at Kleiner Perkins, we met with a lot of interesting founders who didn't go to Stanford or Harvard, who didn't work at Google or Facebook. Yet these founders were building really interesting companies. And every time that Paul or myself would bring these types of companies to our partners to potentially go forward and make an investment, we were always shut down. Primarily because they didn't come from quote unquote central casting, was the term people would use internally. They would say, this founder isn't rock star material. Yet when you peel back the covers, simply because they weren't backed by name your favorite pre-seed or seed fund, like a Felicis or a Floodgate or a first round capital, a lot of the firms on Sand Hill Road just wouldn't give these entrepreneurs a second look. And I remember time and time again, Paul and I, respectively at our firms, would be turning down these companies, and we would scratch our heads and go, man, but this entrepreneur is really doing something pretty miraculous, such little capital. And so when we came together and formed Conductive Ventures, what we wanted to do was really approach and attack this segment of the market that was largely being ignored. Founders who don't naturally have natural inroads into Sand Hill Road, founders who have raised very little capital, they've been lightly financed, they've been very judicious in terms of building their businesses, yet they're still doubling and tripling year over year. These are the companies that we want to work with, and that formed the foundation of Conductive. What's very interesting, though, in 2017, is we look at that market, we were in a 0% interest rate environment, so capital was free-flowing. The most popular funds that were getting funded were really sector-focused, so cybersecurity, crypto, and then also very stage-centric. So we're a pre-seed fund, we're a late-stage fund. And for us, we just really didn't have any of that. We were stage agnostic, sector agnostic, and what we really emphasized was this concept around capital efficiency and unconventional founders.
Right.
And I don't think anyone in the world really cared about what we were about.
Yeah.
And so that's why we went to work on day
Yeah.
one and started trying to find these companies.
Yeah.
And I think that being a contrarian over the last 7 years since we were founded has been extremely helpful, because this year we've had two phenomenal exits,
Yeah.
Jackpocket and Resident, two companies that were really under the radar
Yeah.
for a long time, but have exited for close to $2 billion in total value.
Yeah.
And it's nice to be proven right
Yeah.
that when we first started 7 years ago, we had a pretty unorthodox thesis. And being a first-time fund, when you're unorthodox and unproven, that's
Yeah.
often a precarious place to be, because
Right.
LPs just aren't sure if this strategy is going to work,
Yeah.
or if you're just different and it fails.
Yeah.
They just don't care. So that's why I think we're so long-term, because
Right.
at the end of the day, what we want to do is build enduring companies
Yeah.
that, again, they can be number one in their segment
Right.
over a long period of time,
Yeah.
versus just those quick wins in 2 to 3 years.
Yeah. And you're now in the driver's seat, going back to the car analogy. 7 years in, what has been most meaningful about leading this firm and building around this thesis of capital efficiency and unconventional founders?
I think that number one, because we're in the driver's seat and we're a relatively small firm, we can make very quick decisions, and it doesn't require committees or weeks on end to really come to a decision. And so anything that we need to prove internally or externally, we just have a simple discussion and then we just go do it. So the time from communication to execution is very short. That is something that I greatly appreciate. We just don't spend cycles or waste time on talking about really just things that just don't matter or move the needle.
Yeah.
I think the second part that I think I've really enjoyed is the ability to work with entrepreneurs really closely. That is something that I've always truly enjoyed about this job. This is, for me at least, the most fun part of the job. And so being able to work with them and not have to say, oh, let me push this up to higher ups at the firm and figure out if this is going to work.
Yeah.
You can say, no, like, I'm just going to make the decision, make the call. Yeah, we'll do this. We'll support this and move forward.
Yeah.
So I like the fact that we live by the sword and die by the sword. But for me, I think what's really gratifying is seeing when these things actually happen and then it works. And it's just really cool and awesome when you take a risk, you're being a little bit brave, and then things work out.
And what has been the biggest challenge?
That's an interesting question, because I think the biggest challenge of trying to raise the fund before Conductive was the biggest challenge. It was basically failing and not raising a fund. So I think it's, contextually speaking, after getting Conductive off the ground, it really hasn't been that challenging. Because after you get the capital and you're like a farmer, you're planting seeds, either they sprout and they blossom or they don't. And so you don't get a second fund if you just totally fall flat on your face. And for Conductive, it's worked out really well, right? We're 3 funds in. Fund 1 has basically been fully returned. Fund 2 is already 40% returned. But we've been able to show our investors that our thesis is working. We're making them a lot of money, and so they're extremely happy. So in terms of challenges, I don't think we've really had that many challenges compared to my first experience of trying to raise a fund, where we just totally fell flat on our face and didn't even get the fund raised. That is called challenging. But I think there's a big component of being resilient here. And as I just take stock of the lessons from, the first fund that didn't work out to Conductive, I'm just extremely grateful that it's worked out so smoothly. We've had a little bit of bumps here and there and some turbulence, but nothing that was gonna kill the firm.
And thinking about that, you talked about the failure, not being able to raise, your first fund, and now having that success. Like, what advice do you have for founders who are maybe in the fundraising process now, maybe want to pitch to Conductive Ventures, or maybe haven't had as much success in fundraising right now?
I think there's this common adage amongst founders that if you knew what you knew at the moment in time that you were going to jump off the ledge and be an entrepreneur, you wouldn't do it. Because it just is so incredibly challenging. But I think being an entrepreneur means being able to solve problems. And, you get to solve your next problem after you finish solving your current one. And I think after a series of fixing these problems, you look back and you're like, oh my gosh, we've come so far. And I think as a problem solver, that's what being an entrepreneur is. You just take one step forward, solve a problem, take another step forward, solve another problem. And so I think being methodical and practical about solving these problems is basically what being an entrepreneur is about.
Yeah.
And so I think that's why when you take stock, looking back after a year or 3 years, 5 years, oh my gosh, had I known this is what my life was going to be, my journey was going to be, I probably wouldn't have done it, because it just is so daunting when you do that. And so I feel like that is probably one of the biggest kind of takeaways. If you're going to do this, there is some sort of a blessing in being a little bit naive. Got to be a little bit naive in terms of doing this. And then I think you got to be really honest with yourself. Like, hey, is this what I really want to do? And really take stock of like, why are you doing this? I'll be the first to say that I don't know that I necessarily was really that thoughtful in terms of why this, why now. I think for me, it was just a natural next step of moving from the back seat to the front passenger to the driver's. Again, I always tell people I'm the accidental entrepreneur, in that when I first got to IVP, man, I just thought I wanted to become an MD just like all the other general partners. And that just wasn't my path. And so it wasn't as if I stepped into IVP and the first day I was like, oh, I'm going to go raise my fund one day. That's not at all what happened. So I think sometimes the journey, I think you do what you can to prepare yourself for that moment. And if all the stars align, you've been prepped, you've been ready, and that preparation hopefully gives you more of an edge to be successful.
And what about for people considering a career in venture capital today, whether at different stages, as a first job out of college, first or second job, or maybe in the middle of their careers? Like, what would you say to them for those people considering making the jump?
I think this is one of the best careers you can pick. If in our world you like technology, you like finance, and you like working with entrepreneurs, there's probably no better job in the world. I certainly love this job more than the first day I started in 2004. I think it's a privilege to also do this job. I think a lot of people probably get intoxicated by the power and all the niceties that come with this job and forget like why you're here. This is really at the end of the day a service business. You serve other entrepreneurs. And I think if you keep that in mind, you can kind of keep your feet on the ground, hopefully stay humble. And at the end of the day, I feel like what makes this job so interesting, dynamic, fun is when you get to, again, work with these entrepreneurs. This, as you mentioned, this journey is so long that it's not just about getting into a deal and then exiting the deal. It's this whole journey and this whole process in the middle. And just like professional athletes, if you don't in some way enjoy that process, it's not the final outcome isn't necessarily what it's all cracked up to be. And so I think there's a lot of commonalities between professional sports and venture, in that there is this ability to continue to hone that process of investing, of building a company. And even today, having done it for 20 years, I'm still learning as well. And I think you always have to just keep that in mind. So I think for folks who want to get into venture, I think it's a phenomenal job. I think, like I alluded to earlier in this conversation, try to get exposure through internships and other ways so that you can learn more about the industry and decide if this is something that you want to do. And I would say that even if it's not, at the end of the day, there are a lot of people that I started with 2004 that are no longer in venture, but they're doing pretty incredible things. Many have become entrepreneurs themselves. Many have become limited partners. Many have gone on and had wonderful operating careers. But it's just a great foundational jumping off point as well.
And just the final question, what's next for Conductive Ventures? Now, Fund 3, 7 years in, what is your long-term vision for where you want to take the firm?
So again, we have a contrarian view from Conductive Ventures. So we want to stay relatively small. Paul and I have zero aspirations to raise billion-dollar funds. And it's primarily driven by, at the end of the day, what brings us joy. And what brings us joy, again, is being able to work with entrepreneurs. And if we raise a ton of money, we're going to have to go hire a massive staff in order to deploy that capital. And that would actually get us further away from the day-to-day joy of working with entrepreneurs. We just wouldn't have that bandwidth. We would be managing a firm. We would be managing a lot more people. And honestly, at the end of the day, that's not where I find a ton of joy, and neither does Paul. I think the second thing is we want to continue to double down on this idea of capital efficiency and unconventional founders.
Yeah.
I think if you read TechCrunch, you will believe that most entrepreneurs are venture backed. Yet, actually, when you look at the entire market, very few companies are actually venture backed. So we're actually going after a much bigger part of the market where a lot of entrepreneurs, again, have been super capital efficient, either by choice, by design, or because simply they haven't been able to raise capital or haven't really had a path to that capital. And so I think they're much more disciplined when it comes to raising capital. And then second, our founders are really unconventional because they don't have natural paths into Santa Road necessarily. And so we want to continue to go after that. We don't have some splashy vision of where we want to be, but I think in many respects, one step forward, solve a problem, one step forward, solve a problem. And I think it's the staying power, the ability to be very consistent in our path. We've proven that it works, and we want to continue to do that. I would definitely say that the way that we do venture capital is a lot more work. It's a lot more work from our team. It's a hands-on approach where we can be very supportive to entrepreneurs. And so it's just a different way of doing venture capital. And so when I go back to what I said earlier, you got to do things that make you different. And I think these are the things that really make us stand out and be different.
Yeah, great. I think that's a good place to end.
Okay.
Any parting thoughts?
I hope people actually listen more than
our
parents. Sorry, parents, brothers, cousins.
Yeah.
But at the end of the day, I think the reason why we want to do this is we want to lend a perspective, and hopefully a really authentic one that people can take away and say, hey, you know what? It's very different what they're doing. And I think that the only way that you get that differentiation is when it's actually real.
Great.
Yeah.
Thank you.
That concludes our first episode of Conductive Conversations. Thank you to everyone who listened. Please share feedback with us. Let us know what you think. If there's anyone else you'd like us to feature or interview, email us at info@conductive.vc. info@conductive.vc.